Hi, I'm Jesse Baines with Yahoo Finance Canada. Welcome back to another episode of Editor's Edition. Today we're talking about real estate during COVID-19, something a lot of us probably almost forgot about as we watch the GameStop and Wall Street Bet saga with breathless anticipation. Philosophy's John Pasalis is here to bring us up to speed on the Toronto real estate market. Hey, John, thanks for being here.
Thanks for having me.
And from all the way across the country, we have Oakland Realty's Steve Saretsky. He's in Vancouver. That's the market he looks at. So today we're going to dig into mortgage rates, the condo market, bidding wars, fiscal and monetary policy, and so much more. Let's start with a bit of a look back at 2020, a year for real estate that very few saw coming. And if they saw it coming, they might be a witch or a wizard. I don't know. But anyways, it ended up being the busiest year for real estate on record, according to CREA. We had more than 551,000 homes trading hands over the MLS system. Prices were up 13%. That's the house price index. But if you look at average selling price, even more than that because of a move into higher priced detached homes. Now, that was strength that was widespread. It wasn't just a Toronto and Vancouver story this time. So, John, what does that tell you about the current state of the market?
Yeah, I think that the fact that it's a national is probably the most interesting thing. You know, for the longest time, Canada's housing market was all about Toronto and Vancouver. And right now it's not. It's about all of these other markets where demand is booming. And the other big story, of course, is inventory right now is at record lows across the country. And that's all just pushing house prices up further.
Steve, what's your take on how widespread the strength was this year? We're talking like the territories prices were up just about everywhere. What's your take?
Yeah, I just think central banks have pumped the system full of liquidity. And I think if you always look from a broader perspective, right? So I try to look outside of Vancouver and see what's happening on a national level. And clearly we can see, the national housing market is booming. And then, look at our neighbors to the south in the US. I mean, they're seeing same stories are playing out, right? The single family housing market's ripping hot over there. You got massive equity gains, actually the largest since 2006, 2007. So I think that financial markets, and obviously Canadian real estate being one of them, are one of the beneficiaries of all this money being pumped into the system.
So with that said, Steve, looking back to our first conversation, I know you guys don't like to make predictions, but I'm going to put you on the spot here. Starting with you, Steve, what is 2020 going to look like in terms of sales and price appreciation, if you could give it like a bit of a range?
Yeah, what was that? I think John commented, about 3 or 4 months ago, I said, the next move for Canadian real estate could be a face-ripping rally higher. I got absolutely dogpiled online for that. But, that's kind of been the case. You look at the numbers, I think the data speaks for itself. And I understand that people are frustrated and they're looking for someone to blame. But don't shoot the messenger. The reality is the data points higher. And so as long as the liquidity is pumping, which the central banks, Bank of Canada seems determined to do, you're coming off record low levels of inventory. Just for prices to start balancing out, you're going to need inventory to build, and that's going to take some time. So in my opinion, you have a runway here for higher prices. And I think that is in the data, and the data speaks for itself. So in the near term, I think it's pretty clear prices are going to move higher. The longer duration, how this all plays out is anyone's guess. But I think in the near term, it's pretty clear.
Right. And we will get into central banks' monetary policy and its asset purchase program a little bit later in the show. But John, what is your I know forecast, it's not a word that you guys like to use, but if you had to make a bit of an approximation for what you expect to see in 2020.
Yeah, I think Steve's 100% right. I mean, all indicators, at least now in the GTA, are pointing for a market that's going to keep heating up. Like there's no even signs of it slowing down. So all signs are, at least the first half, we should see a lot of strong price growth. Again, the key thing is just understanding when things start to cool down. We don't know. It could be the second half of this year. It could be the start of the next year. But I think at least over the next 6 to 9 months, we're probably going to have a really, really hot market in the GTA.
So one of the groups that their forecast did not happen so far, CMHC calling for up to, I believe it was 18%, I could be wrong, between 9 and 18%. So now I want to be crystal clear. This was not a forecast. CMHC isn't saying it expects this to happen, but in its stress test, it did say house prices in its worst case scenario, we would need to see a W-shaped recovery, which is a partial recovery followed by a resurgence of COVID, and then a prolonged recession, loss of confidence. There would be no government assistance, stocks and oil would fall, and 4 mid-sized financial institutions and 1 private mortgage insurer would fail. So if those conditions were to happen, CMHC says house prices could fall 47.9% peak to trough with an unemployment rate of 25% in its worst case scenario.
I mean, I don't even know why they report these worst case scenarios. I mean, again, government policymakers probably have all sorts of worst case scenarios. I don't see what the benefit is in reporting them. The reality is this is completely unlikely. I mean, there's so many ifs attached to this, including ifs that the government has control over, which is, will they be supporting with fiscal measures? And this assumption is that the government's going to see the entire economy collapse. They're just going to sit back and say, well, we're not doing anything. We'll see how this unfolds, which is completely unrealistic. So I don't think we should really look too much into these measures. I think the bigger risk is like a rapid acceleration in house prices. It's the opposite of what they're worried about. The bigger risk is that prices are going up 35-40% per year, which eventually might lead to a deep correction, not that we're going to have this massive crash in the near term.
So again, to be clear, CMHC is not forecasting a fall 47%, but even in that worst case scenario that they lay out, is such a drop even possible, and does it give people a false sense of hope?
Yeah, I mean, I think that people just kind of read the headlines and didn't do a whole lot of homework. I mean, CMHC, as far as I'm aware, stress tests their portfolio every single year under these adverse scenarios. So I'm not going to say rule it out and say it'll never happen. Of course, I mean, we've seen many countries go through significant housing busts, and obviously the larger that Canada gets, the larger our housing bubble, gets, is obviously the more systemic risk that it creates. But this notion that policymakers are simply sit back and just let it happen, I think is a complete fallacy. And I think we've seen the length at which policymakers are willing to go to support financial markets during this pandemic. So obviously, again, we can talk about central banks buying corporate debt and changing all these rules. And I mean, so there's so many policy levers that they'll opt to go through. And I think that, again, when basically, I mean, let's call a spade is the Canadian economy is built on housing. So you got 25, I think it's 23-24% of the economy is through the FIRE sector, right? So finance, insurance, and real estate. And so they're basically, and the larger that it gets, they're more inclined to have to support it. That's not to say that corrections can't and won't happen, but I think that it's certainly a low probability event.
Okay, so that's a good segue. Let's talk about policymakers. Starting with you, Steve. Governments often come out with these measures, like we saw in the fiscal update about a foreign buyers tax and increase of the first-time home buyers incentive. Is there a misconception? Do you think that the governments actually want house prices to come down to have house prices continue to go up? You mentioned it's a huge part of our economy.
My honest opinion is, if you look at the way that the financial system is built, it is predicated on house prices continuing to gradually increase. So the reality is you're in a credit-based financial system where you need to create new credit, and the majority of that credit is created by issuing new residential mortgages. And governments obviously get the majority of their tax revenues, or a lot of their tax revenues, off of real estate. So although they might pander to voters and try to bring in these policy measures that look like they're doing something, in reality, I think that they're incentivized essentially to support the housing market. And so that's my honest opinion.
John, same question to you. I'm putting you on the spot a little bit again here, but is there a false sense of a false feeling that governments have our back and actually want first-time buyers to be able to afford to buy a home? Are they happy watching prices rise as rapidly as they are?
Yeah, I mean, I think people can just
afford to buy a home. Are they happy watching prices rise as rapidly as they are?
Yeah, I mean, I think people can just, look at how government's reacting to the fact that house prices are rising 30+%, at least even in the GTA. I mean, Bank of Canada's reaction is this isn't a problem. We don't need to worry about it. CMHC in December came out and said, there's low risk of rapid appreciation. House prices are affordable in Toronto, and there's low risk of overvaluation and of a deep correction. So the reality is they kind of want to keep house prices high. And I think a lot of the policies they put in place, like this first-time homebuyer incentive, are more political. They didn't really do anything. It doesn't make home prices more affordable for first-time buyers, but it's something that politicians can say that they're doing when it's really just not doing anything.
And one of those reasons that house prices have been so hot is, of course, low mortgage rates. Now, Rates by Great Mortgage blog says it expects mortgage rates to actually even fall further in the summer because of the difference between the spread between the prime rate and the banker's acceptance rate, apparently at a 12-year high. So that gives them more room to discount. Now, if banks actually start giving variable mortgages during the summer months, what is that going to do to the housing market? John?
Yeah, I mean, I think it's just gonna keep adding fuel to this fire. And if we end up seeing a little bit of buyer fatigue, I mean, low rates just might keep buyers coming back into the market. And I think that's probably all it's going to do. I mean, already we're seeing that with rates as low as they are. A lot of this is just driven by the fact that debt's so cheap right now. You can get a mortgage for 1.5%, and it's making it very attractive if you're a first-time home buyer.
And Steve, what would that do to the Vancouver market in the summer?
Yeah, I mean, I think it's certainly playing a role. I hate to say, Tina, there is no alternative, but when you eliminate the bond market and you have rates at 1.5%, it's just you're borrowing below the cost of quote unquote inflation. If you actually believe inflation's hovering around 2%, which the Bank of Canada says is actually below that, so it's a real negative interest rate essentially. So you're borrowing at a real negative interest rate. So I mean, it really just encourages speculation. And obviously, we talked about it earlier on the show. If governments really wanted more affordable housing, all you'd have to do is raise interest rates, and that would probably correct a lot of the issues.
The Bank of Canada didn't move on a 10 basis point micro cut, as some are calling it, as some thought would happen. But Governor Tiff Macklin did leave the door open. Here's what he had to say. Have a listen.
Reducing the effective lower bound from its current level of 25 basis points to but still positive number is one of those options to provide additional monetary stimulus.
So, John, do you expect a 10 basis point micro cut? And if we do get one, what will that do to the housing market?
I don't know if it's going to happen. I mean, I think they have so many tools that they can kind of use to stimulate the market further if they wanted to, if they wanted to sort of fuel house prices. I don't think that's the biggest thing. If they feel it's important, that's fine. But there's so many other options to kind of keep the housing market going. I don't think even that's the biggest one. I mean, even if they relax the stress test, which they were planning to do, and make it a 2% test, so 200 basis point test, rather than a 3% test, which is what it is today, that'd have a much bigger impact on the housing market. And I would think that that's probably something that they're more likely to do in the future if we start to see the housing market cool down.
And Steve, it looks like the lights went out, but don't worry, we can still see you. So let's just power through. So the same question to you. Do you think a 10 basis point cut is on the table, as he says, as he alludes to? And do you think that will make a significant difference? 10 basis points doesn't seem like a lot, but I mean, we're already at.
I mean, I think maybe from a psychological perspective, just seeing that. I mean, I think there's certainly a crowd out there that believes that negative interest rates are still a possibility. I don't know. It'll be interesting. I know that the Bank of Canada is watching the exchange rate, and so if that starts to sort of creep, Canadian dollar continues to strengthen, that maybe again they'll cut to that 10 basis points. And again, I think that low rates as they are today are certainly a huge driver of what's happening in our housing market.
Now, notice he said but still positive, not negative. But he has never completely ruled out negative rates. It's a super sexy topic that people get really interested in. What are the chances that well, we talk about this all the time, but like, I mean, for people that are tuning in for the first time, negative rates in Canada, is it a possibility? What needs to happen for that to take place here, Steve?
I mean, I guess it would be your next sort of downturn, if you get one. I mean, obviously downturns are always inevitable, so I think that they might be forced to, potentially go there. I think that if you look at a lot of these, a lot of other countries, I mean, certainly Europe and other parts of developed markets do have negative interest rates, and so I think it's kind of like central banks are almost playing this race to the bottom. This almost like essentially like a currency war where everybody's trying to kind of devalue their dollars. So I think that the Bank of Canada, whether or not they want to go negative, might actually be forced by other central banks to follow suit.
John, negative interest rates coming to Canada?
I mean, it's hard to speculate what might trigger that, but at the end of the day, I mean, things would have to get a lot worse in Canada to have negative interest rates, and it looks like things may be recovering. I mean, certainly the booming housing market's helping. So I don't know if it's in the cards in the short term.
And the other side of the Bank of Canada's activities, of course, massive asset purchase program, quantitative easing. Some economists, including at CIBC, are calling on the bank to start tapering. Steve, do you think that it can, or will it, if it can?
I'm personally in the camp that you can't really taper. I think you can try to taper, and as soon as you taper, bad things start happening. And I think we saw that from the Fed back in 2018, at the end of 2018. Obviously, when the stock market took a tumble, and they said, "Oops, okay, never mind." And so I thought we're probably in a similar position. That again, once you kind of start QE, it's very difficult to exit. So I don't know. We own 36%. The Bank of Canada owns 36% of the government bond market, and they're expected to own 50% by next year. So they're certainly climbing rapidly in terms of their ownership. But again, I think it's going to be very difficult to exit.
Okay, so let's move on because I want to get to a lot of the other topics that I have on the agenda here, which is let's start with your local markets. John, in Toronto, what's Toronto looking like in January and generally speaking going forward? What do you see happening?
Yes, a super competitive market. So if we look at the suburban market for houses, they're on fire. Prices and basically all of the suburbs of Toronto for houses are up over 30% year over year. Condos in the suburbs are probably up around 5-6% year over year. And the downtown Toronto condo market's doing something quite different. So condo down in the city of Toronto over last year. And house prices, while still up, are not, maybe about 14-15%. So not as crazy as the suburbs. But we've seen a big return in demand for downtown condominiums. And I think that's probably going to lead to eventually a bit of acceleration in prices for condos downtown.
Despite its comeback, it still has serious headwinds. I mean, we're looking at some data from Urbanation, 162% annual increase in year-end active listings to a record high 8,066 units. Condo apartment average rents down 17% year over year in Q4. With numbers that, John, that seems a little bit scary to somebody that might be a condo investor.
Condo investors are a very optimistic bunch, so they're not worried too much about the pessimistic headlines. At the end of the day, a lot of them are seeing this decline in prices as a buying opportunity. They see the decline in rents as short term. They see what's happening in the suburbs with prices exploding, and they think it's just inevitable that downtown load. And the second immigration opens up again, rents will kind of return to the rapid acceleration we saw in the past in bidding wars. And I think this is really what's driving the demand from investors in the downtown core. Unbelievably low interest rates, which is making them look even more attractive.
Steve, what's the Vancouver market looking like? I think the latest monthly stats just came out yesterday or today, and I believe it was like a 50+% increase in sales.
Yeah, it was a 52% year-over-year increase in January. So it was the strongest outside of January 2016. Again, like
increase in sales.
Yeah, it was a 52% year-over-year increase in January. So it was the strong rate outside of January 2016. Again, like January 2016 was kind of our getting close to the peak bubble. I think we had 30% price growth on a year-over-year basis back in January 2016. Obviously, a lot of foreign capital coming into the market at that time. So to compare to those levels, to say that January 2021 was just off the 2016 highs is definitely telling. Again, it's a tale of two different markets. You really have majority of that strength is concentrated in the single family housing market and in the townhouse market because everybody's wanting more space. Everybody's wanting to upsize during this pandemic. And, again, if you're trying to upsize in the single family market, 2021, if you look at inventory for sale, so if you compare it to, December or February, March, whatever, inventory has never been this low for single family. So, I mean, it's a horrendous market for buyers. But if you're a seller, you get to dictate the terms. You're seeing rapid price growth. I mean, the MLS benchmark is telling you prices are up 10% year over year. It's actually a lagging indicator. It's probably closer to about 15%. And I think we'll probably see those numbers get the first quarter.
Are we seeing the crazy bidding wars in Vancouver that I'm hearing about here in the GTA, Steve?
Yeah, single family housing market is all, basically all cash offers. Every house is getting 5, 6 offers, sometimes 10 offers, whatever. That's where the majority of the competition is. That's where like the froth is really coming from. Because if you look at the downtown or just the city condo market, it's still balanced to sort of almost even favoring the buyers a little bit. So, but it is picking up. It's getting stronger. I think it's a little bit like 2016, where the market was led by the single family housing market as prices just got so insane that people were forced down the housing ladder. And again, that's why we're seeing right now the townhouse market has gotten really busy and the condo market is now starting to pick up as well.
So, Steve, is that townhouse market picking up because detached are just impossible? So it's the next best thing after condos, looking for more space?
I'd say that's precisely what it is. Yeah. It's just everybody wants, like in Vancouver, like a third bedroom is almost considered like a luxury. So obviously as a family that's spending 90% of their time at home right now, everybody's looking for that third bedroom. And if you keep what's happening in the single family market is reality is most people are getting priced out. And so they're getting forced into the townhouse market.
Yeah, I can't imagine 2 bedrooms with a family. I mean, this is probably too much information, but I don't even sleep with my wife because I like my space. We have separate bedrooms. So I can't imagine being squished into 2 bedrooms with the kids too. John, what's this? Are townhouses a popular option in the GTA for the same reasons?
Yeah, and I mean, really anything under $1 million is unbelievably popular and competitive. Townhouses, of course, like the more central you are, and even in the outer suburbs, I mean, you get detached for under $1 million. So that's kind of the price segment that's been the most competitive. And generally, the further out you go, the more competitive it is, interestingly enough. I mean, we looked at the most appreciating neighborhoods in the GTA in 2020, in the top 10. 4 of them were rural neighborhoods, which is just mind-blowing because rural neighborhoods normally don't appreciate very much. It's like they're usually the most sluggish markets. But in 2020, that's where everyone was buying.
Yeah, like what was it? What were the Woodstock, Ingersoll,
Scugog, and oh yeah,
yeah. It's amazing. I mean, yeah, those are places where if you're lucky enough to not have to work in the core that you want to move to, and it's affordable. But Steve, what are the Vancouver equivalent or the BC equivalents of places like that, and are we seeing the same thing?
Yeah, I mean, like parts of remote areas of sort of BC, like the interior is red hot. The Kootenays. We're seeing a lot of people pumping into Kelowna, very popular destination. People looking for single family houses from the city of Vancouver, basically moving out there. You're seeing a lot of activity on the islands. So we've got I think Bowen Island, which is, you have to take a ferry from West Vancouver over to Bowen Island. It's about a 30-minute ferry. and detached prices over there are up 30% year over year. Gibson. So it's kind of, yeah, these more remote sort of summer vacation spots, more or less, are seeing tremendous price appreciation. It definitely feels like the further out that you go from the inner city, the hotter the market.
So, Steve, for people that are watching that are lucky enough to own a home in these hot markets and they're getting ready to sell, cash out, move, whatever, who knows what the motive is, but what advice do you have for anybody getting ready to put their house on the market?
Listen, I think that the market is certainly, for a single family house, I think it's frothy. I think that, don't get me wrong, there's probably still some runway for prices to go up, and they could easily go up another 5-10% this year. But I think that it's going to be quite rare that you have the lowest inventory ever. So in terms of thinking to sell, I think that it's a pretty good time to sell, and it's a really not bad, to be honest. And so, yeah, I think if you're looking to sell, you take advantage of the low inventory situation right now, and you price it a little bit more aggressively. You get a whole bunch of offers come in, and you get to pick your terms and conditions.
Yeah, somebody was telling me that there was a house their friends were selling in Pickering, Ontario, and had 74 offers. So imagine going up against that. John, what's your advice for somebody that's looking to sell a home right now?
Yeah, I mean, the exact same advice with Steve. I mean, the record low inventory right now, and as a seller, you want to take advantage. This is the periods where you probably get these prices that are probably that are higher than what a house is worth. Come spring, it'll still be competitive. Usually we end up seeing more inventory, so less competition. So generally now is, again, great time, similar to Steve saying, great time for sellers. It's very difficult for buyers.
Right, a difficult time for buyer, but sorry, Steve, did you want to?
Yeah, I was just going to add something quickly. John, I don't know if you're having the same sort of experience, but like, it's almost becoming difficult to price something in the single family market. So for example, it's like I can run an analysis, I can look at the sales comparables and say, okay, your house is worth 1.5 million based on these recent sales. But what happens in these multiple offer situations, and it gets so competitive and people get so emotional, the house could easily go for 1.65. Or even 1.7. So it's hard. You can say, hey, I think you're worth 1.5, but let's just see how many offers we get, and maybe it could go for 1.7.
Yeah, we're seeing the exact same thing. I mean, we just sold a house actually a couple of days ago. We told their client we were going to get a certain price, and it ended up we got about 10% higher than that, and that's partly just driven by the most recent sales. I mean, when we looked at the comparables from last year, we came up with a certain market value, but literally in the past 4 weeks, a few houses sell for more than they should have, and that kind of just starts pushing all the house prices up a little bit higher. So it is very tough to price things sometimes because things are moving pretty quickly.
Okay, and quickly, we're running out of time here. So John, as you guys have said, and obviously buyers are in a much more difficult situation. What advice do you have for people that have to need a home right now? Their lease is done, or they had a plan to buy, and for whatever reason they have to buy. What do you tell them, John?
Know what a house is worth before you bid on it. Don't compete for offers. Look for the houses that don't have the nicest photos. There's all sorts of things that you can do to get an edge. Most people don't do them, but there are things that you can do to find some value in this market. But competing with 74 people is certainly not one of them.
Same question to you, Steve.
I would say my biggest thing is don't over leverage. Like, I think people sometimes just reach for the stars because they feel like they're never going to get in. And don't get me wrong, like, I think the market still has upside for sure, based on all the data, but it's a frothy housing market. There's always some road bump, speed bump around the corner. And so I think if you're planning to buy today, you do have to have a longer term outlook, because you could very well buy a single family house today in one of the most competitive markets we've ever seen. And, by next year, who knows, maybe the prices are down 10%. I think that people have to be very cognizant of what they're able to stomach, and sort of, what their outlook is in terms of their living situation, right? Don't be buying a single family house and thinking that you're going to automatically be able to sell it for more money in a year and a half from now.
Yeah. Okay. Well, we'll have to see where prices are. Who knows? This has been a wacky market for sure. So thank you so much, John Pasalis of Realosophy Realty. A lot of good food for thought.
Thanks again for having me.
Thanks for being on. And Steve Saretsky of Oakwyn Realty. I always want to call you Steve Oakwyn for some reason. Steve Saretsky of Oakwyn Realty. A lot of good food for thought. Let's hope you don't get yourself into trouble on social media for some of the things you said today. Nothing outrageous, obviously. But,
oh, yeah, I'm sure I'll hear it. So looking forward to the feedback.
Yeah, so be sure to check both of them out and follow me on Twitter. If you have any questions that you want me to ask John and Steve in an upcoming episode, or if there's any topics that you think we should be covering, let me know. And just a quick programming note, we're moving to a 3-week rotation instead of a 4-week, so you'll be getting more of us on a bad thing. But in the meantime, check out Yahoo Finance Canada for all your real estate news. Check out stock prices, anything from GameStop, BlackBerry. You look at silver prices, Bitcoin. There's so much to keep track of these days. News about the economy, tech, cannabis, and so much more. See you next time. Prices, Bitcoin. There's so much to keep track of these days. News about the economy, tech, cannabis, and so much more. See you next time.